Hello, good evening, everybody. How are you today? Uh, Thank you very much for coming to the BYIC Bursa Young Investor Club monthly webinar. This is the third series called Understanding Market Indices and Sector. And today we are very honored to have invited our same guest again from PJ, and who is a seasoned investor with 20 over years of experience in investing and trading. He's also one of the best-selling authors of 2 books. Now, before we begin, I want to check the audio. So if you can hear me, could you please click the raise the hand button. On the control panel, you will see a raise the hand button. If you can hear me, could you please click raise the hand button? Okay, thank you. Thank you. I see a lot of hands now. Thank you. There are still a few hands not yet raised, like Kok Hao, Rohaya, SK. Can you hear me? If you can, please raise your hand, okay? Okay, now if you can hear me, you can put down your hand now. You can put down your hand now, thank you. Okay, you can unclear the thing, put down your hand now. Now, let me show a little bit of my webcam. Hello, this is me. I'm Chun Sian. I'm the host for today. Again, welcome everybody to this BYIC webinar, the third series, Understanding Market Indices and Sector. So to begin, let me share with you what we have today. Now, just want to let you know that Bursa Young Investor Club webinar series is a monthly webinar whereby we will share with you the basic to the intermediate level of how to invest in the stock market. So every month we will have a webinar, and this is brought to you by the Bursa Malaysia, and I'm the host. So the first month we'll talk about introduction to the stock market, and the second month we talk about the basic things about investing in the stock market, or the trading process, who are the brokers, who are the regulator. And the third series we'll talk about market indices and sectors, and which is very important because I believe that everything we do when we invest in stock, we're investing in businesses, and businesses move in economic cycle, and during which cycle there are some businesses who will do well, and during different economic cycle there are other sectors who will do even better. So it's important that for us to learn some market indices so we can learn how we can take advantage of the sector rotation. So we usually do it on the third Tuesday of the month, and this month we'll talk about market indices and sector, and next month we'll talk about fundamental analysis. So if you want to learn how to do fundamental analysis, you should come next month, and then following month we have technical analysis. Then we have combining fundamental analysis and technical analysis. So this will be the 6th series. Second 2 series have been done. Today is the 3rd series, and then after that we have 3 more series. Okay, so let me briefly introduce our speaker today. Our speaker, he graduated from NUS Singapore. So if you know somebody from NUS, you know he must be very, very smart. So he has more than 26 years of working experience with several publicly listed companies and multinational companies. And he's an author of Invest in Foreign Shares, which reached popular top 10 bestsellers, and also an author of a new book called Invest in REITs, which has just hit the shelf. So he's a full-time investor, author, trainer, and investing in Bursa and international market since 1995. So when I first met him, he really blew my mind. He showed me a lot of facts and how the market move, and I immediately know that I want to invite him to our webinar series, because if I don't do that, I feel not very good because I want to let real stuff to reach the public. All right, so without further ado, I would like to introduce him, but because I am just concerned about the internet connectivity, because if I can stop sharing my webcam, I can utilize my bandwidth even better. So if you allow, I will just stop sharing my webcam so that the internet connectivity can be better and you can hear it better, right? So I will just stop my webcam for now. All right, so without further ado, let's welcome PC Wong, and it's over to you, PC.
Okay, thanks very much, Chun Sian, for the introduction.
I just made you the presenter,
Without much
so they
ado,
can see your slide now.
okay. Yeah, okay. So thank you very much, everyone, for logging in. So today we are going to talk about understanding the market, indices, and sector. We will have some very exciting things to share, but on those more academic stuff, I will briefly run through because those you can actually follow through later on. But I think most people will be more excited to understand about markets rather than the academic stuff of what how does a company goes into the main market or the ACE market. So let's talk about understanding market, indices, and sector. So today we'll talk about what is an index, the world indices, understanding the FBMKLCI, understanding the main market and ACE market, what are the sectors in the capital intensive industry, and what are the sectors in the non-capital intensive industry. Now when we move into the capital intensive and non-capital intensive, you'll be very surprised about how they are being categorized. Yeah. So let's talk about an index. What is exactly an index? It is a stock market. A stock market index actually consists of the weighted average price of a selected pool of stocks. So, for example, if let's say the index consists of 30 component stocks, then it will be the average weighted price of all the 30 components. Okay. Now, investors use the index as a tool to measure their investment against, or an indication of the sentiment and direction of the market. So this means that if let's say the FBM KLCI, has already increased, let's say 20% over the last 3 years. So investors would look at their pool of stocks and gauge whether they have likewise exceeded or fall below the index. Then they can gauge whether are they investing in the right, using the right strategies, or are they underperforming the index? Some of the mutual funds, they also gauge against the index performance, because if let's say their performance fall below the index, it means that they need to back up. Otherwise, investor would want to redeem, their mutual funds for cash, and then they would have lesser money for redemption. So this is very important for fund managers to track their performance against. And for a lot of retail investors like us, we often look at the index as a form of sentiment, whether it is negative or positive, and the direction of the market. These are, for more detail, you can go into the subsets of the various indices. Then you will gauge whether certain sectors are doing well or certain sectors that are not doing so well. In Malaysia, the operation of the FTSE, Bursa Index, Bursa Malaysia Index, including the FBM Kelsey, is the responsibility of the FTSE. The FTSE is often referred to as the FTSE, which is actually based in London. They will actually liaise with the Bursa Malaysia. The relationship between the FTSE and Bursa Malaysia is that of a partnership. Reviews are conducted semi-annually in June and December. A stock may be taken off the index and the new stock may be selected as a replacement. So let's talk about the world indices. There are many stocks exchanges in the world, and investors pay attention to the major indices for direction on the local market, as major indices like the NYSE and Nasdaq can influence worldwide sentiments. Now, the major indices in the New York Stock Exchange would be the Dow 30, okay, which are the 30 components of the Dow Index, and they also have the S&P 500. Okay, these are normally the major indices, as well as Nasdaq, because it would influence a lot of, let's say, those in the biotech or in the technology sphere. So in Asia, the performance of the Asian indices like the Nikkei and the Shanghai Stock Exchange Composite Index can have an impact on Malaysia stocks. Let's look at it, how the world indices have affected Malaysia's stock market. Now, this is the FBM KLCI index from 2005 to 2015, and we will explore the negative impact. Now, you look at it that in 2008, onwards, the stock market, the KLCI have actually fallen very, very low, below the 1,000 points. Okay, so during this period, okay, what we have is the global financial crisis. The Dow index fell 54% to 6,507 points. So this heavy drop of the Dow index have also affected the KLCI in that it has also fallen off fallen off a cliff. Then later on, as a lot of stimulus kick in, during the 2011 to 2012 period, we have the Europe debt crisis, okay, where the Europe stocks 50 index fell 30% to 2,026 points. So you will see that the KLCI also dropped because of the European debt crisis involving Greece, Spain, Italy, and Portugal. So this also impacted the KLCI to a certain extent, okay, though much lesser, because if you look at it, the US market is actually, talk about the NYSE and the NASDAQ, they are the top two markets of the world, and their turnover is in, if I'm not wrong, could be around, last time I did check was more than 25 trillion US dollars. Okay, so that's why when you have markets that are doing trading value of more than 20 over trillion, it could be 30 trillion right now because the indices have actually moved up, you will see that it has a tremendous impact. Our Bursa market is around 100 over to about maybe 200 billion US dollars in value. So it has a tremendous impact when we look at what happens in the US market. Whereas in the European market, it's a bit muted, okay, but it still have some impact. Then as we move along, okay, towards the middle part of this year, we have the Shanghai market crash, okay, the SSECI fell 30% and almost 1,400 companies halted trading. 1,400 companies actually suspended from trading because of the sudden crash. You look at it during this period, also the KLCI experienced a fall. So all these things that happen externally will have a certain influence to the local market. It depends on how great is the crash. Okay, like definitely whatever that happens in the US will have tremendous bearing, as we can see here. But if it happened around certain region and in China, you can see that it is a bit muted. It wouldn't cause a tremendous drop unless it is a global economy slowdown. Okay, like what happened in 2008, where we had the global financial crisis. This one is very much related to China, and this one very much related to Europe. If, let's say, a same crisis that happens in US, Europe, and let's say major Asian indices like the Hong Kong Stock Exchange, the Shanghai Stock Exchange, and the Nikkei, the Japanese Stock Exchange, okay, the Japan Stock Exchange, we will see that the drop can be very tremendous. So what I've seen here is actually a negative impact. Okay, let's look at the positive impact. Now, we know that this was the period during the run-up, okay, before the crash. Okay, and you see the KLCI also peaking somewhere here. Now, this is during the crash, and during this period, the US implemented QE1, okay, to increase the liquidity in the market, okay, to boost people to invest. Okay, then you see the Dow component, okay, dropping. Just now we see that it dropped to 6,000 points, but now, okay, it moves up to 10,000 points. Okay, so this is the period during the QE1, and then further on they added QE2. Okay, QE2 was added somewhere around the peak just before the European crisis struck. Okay, and then they have the QE3, and you see that the Dow component, okay, the Dow component is moving upwards. Okay, from a low of 6,000 points, it went up to 10,000 points, 12,000 points, and then 17,000 points. And each time you see that the KLCI also track the kind of movement. Okay. So this is how foreign indices can influence the Malaysian stock market. Because right now we live in a world of total globalization in terms of trade. Any trade-dependent country, cannot be immune to any market shocks. So that's why it does pay attention for you to also see what's happening outside of Malaysia, so that you know what are the sectors to go into. So some of the major indices in the world are actually the Dow 30, the S&P 500, and Nasdaq 100. Okay, the 150, 530, all these are number of component stocks in the index. Okay, the FTSE has 100. The CAC is the French index. It has 40. DAX is Germany, 30. Then you have a component of EU stocks, where you have the Europe stocks 50 and the Europe stocks 600. Okay, then you have the Shanghai index 50, Hang Seng index 50, the Nikkei 225, and the Topics 100, and the ASX, the Australian Stock Exchange 200. So these are the major indices that can actually impact. For example, Australia being a resource-rich country, if let's say the ASX start to move downwards, okay, it could be that commodity prices are actually falling. And that is an indication for you to know what are the dangers that lie with commodity stocks in Malaysia. These are the kind of indications that you can look at. Okay, let's talk about the FBM KLCI. I will briefly go through this because it's pretty academic. Okay, the FTSE Group partnered with Bursa Malaysia in 2006 to provide a suite of indices for the Malaysian market. Okay, the FBM KLCI was implemented on 6th of July 2009. Consists of 30 companies to replace the older KLCI, which at that time consisted of 100 companies. Main objective, of course, is to allow the standard format of calculation, okay, to increase transparency and push Malaysia's stock market into the global arena. Okay, the 30 component stock of the KLCI, these are all the 30. Okay, but one of the important things is to qualify the companies must have a free float greater than 15%. So which means more than 15% of the stocks must be floated, okay, and traded. So understanding the main market suitability for listing, okay, all these are actually prior to the IPO, the company's suitability will be assessed to determine if it meets the two benchmark, which is the regulatory benchmark and the market benchmark. Regulatory benchmark is a prescribed set of rules under the Securities Commission of Malaysia, equity guidelines, and Bursa Malaysia listing requirements. Market benchmark is dependent upon investors' expectation of the company's business. Okay, so regulatory framework, a company must have the following attribute: identifiable core business as a principal source of income, good management. This covers the years of experience and qualification of the management team. This is more prevalent when the manager is on technical fields and all those. They must be highly qualified professional, especially from the engineering side, okay, or the chemical engineering side, besides let's say civil engineering and so forth. Okay, if let's say if let's say it's a hospital that is being run, they must have top-notch doctor. So there should be no conflict of interest. All outstanding issues must be settled and resolved. Strong business prospect, healthy financial position, and corporate governance. Also, quantitative assessment, they will actually have a profit test, okay, where the benchmark is set at 2 to 3 5-year full financial, aggregate of at least 20 million, and profit after tax of a minimum of 6 million. Okay, so the market capitalization test is that it must have at least 500 million upon listing, incorporated and generating operating revenue for at least 1 full financial year prior to submission. The IPO price must be minimum of 50 cents per share. Okay, again, public spread, minimum of 25% for the company share capital, minimum of 1,000 public shareholders holding not less than 100 shares each. Okay. So Bumiputra equity requirement, allocation of 50% of the public spread requirement to Bumiputra investors on best effort basis, exemption from Bumiputra when, let's say, the companies are with MSC status, bio-nexus status, and companies with predominantly foreign-based operations. So the main market, as of the end of October, there are 812 companies, and the Bursa market, main market stands at 1.6 billion ringgit. That is about 1.6 trillion ringgit. Okay, so value transaction year to date at the end of October touched 386 million with a total volume of 243 million units. So the average transaction per month is about 38 million ringgit, and the volume of transaction is 24 million units per month. So about the ACE market, companies wishing to list on the ACE market will subject to the same test as the Bursa in terms of regulatory benchmark and market benchmark, but the regulatory benchmark may have certain changes. Let's see what they are. Okay, so for a regulatory framework for the ACE market, there is a mention of sponsors. Okay, there must be a sponsor to remain with the company for at least 3 years post-listing. Okay, growth prospect is core business and the industry are expected to have visible growth trajectory in the future, capable directors and management, commitment to compliance. So you see there are certain listing requirements here, okay, that emphasis on management and commitment to compliance and growth prospect. But you realize that financial position, they just mentioned that working capital for at least 12 months. They didn't specifically mention how much the revenue, profit before tax, or profit after tax. Okay, directors must understand their fiduciary duties, risk management, internal control, and risk management systems are in place, and corporate governance. Again, they stress a lot on the management because in the ACE market, they want to include as many growth companies into the listing process so that they can actually draw funds to actually explore new business concepts and all those and develop new business opportunities. So in terms of quantitative test, you see that there's no profit test. Market capitalization, there's also none. IPO price, there's no minimum. Okay, but the public spread must be a minimum of 25% of the company's share capital. Okay, a minimum of 200 public shareholders holding not less than 100 shares each. So again, the Bumiputra equity requirement, there are some changes here, and the exemption from Bumiputra remains the same for MSC status, bio-nexus status, and foreign-based companies. Okay, so currently there are 109 companies listed in the ACE market. As end of October 2015, the total market cap stands at 11 billion. Okay, value of transaction year to date is 26,000 million, which is 26 billion. Okay, and the total transaction volume is 114,000 million. Okay, average transaction per month is 2.6 billion. Okay, and volume of transaction is 11.4 billion units a month. Okay, so we go into the main market sectors. Okay, the main market is industrial products, construction, plantations, hotel, REITs, special purpose acquisition companies. Okay, these are when they created a special vehicle. Okay, finance, technology, properties, IPC is independent power, mining, and closed funds. In the ACE market, you have trading services, finance, industrial products, technology, and consumer. So both are in the Bursa website where you can see how they categorize it. But I think our most interesting topic today would be differentiating between capital intensive and non-capital intensive industries. So for example, Capital intensive industries are those industries which require heavy investment in hard assets such as land, plant, and equipment in order to generate income. So what we mean by this is that, for example, plantation, okay, you cannot just see an empty plot of land and then decided to plant. That land have to belong to someone, and you have to acquire the land. Then you have to then only you can use it for agricultural purposes. Now, assuming let's say it's oil palm, after you acquire the land, then as the oil palm mature, then you have to build a processing plant. Okay, so all this costs money. And let's say in heavy manufacturing, let's say in the steel industry, you need to have a furnace to melt the iron ore, okay, and you need heavy equipment to move the ton loads of steel and iron ore. So all these are very capital intensive because heavy industry complex, where let's say you compare it to let's say a bottling plant for Coca-Cola or FNCC, let's say, you can really differentiate. Once you have the factory process, okay, implemented, you have robotics there to help with the or smart equipment to move the consumer products along, then that's it. It is continuous until you upgrade for maybe increasing the capacity. But in a foundry, let's say where they melt iron ore and coal to generate steel, the furnace have to be very, very big. You have a lot of equipment to move all these heavy loads of tons of steel and iron ore and coal. So that's why the investment prospect to start off that business is very, very different versus a bottling plant. So even in industry, like we see here earlier, we say industrial products, but industrial products, although by a sector itself, also consists of capital intensive industry and non-capital intensive industry. Yeah. So it makes more practical in your assessment when you divide it into capital intensive and non-capital intensive rather than just by sectors, because it will impact how you evaluate the ratios, certain ratios, and I will share with you afterwards. Now, non-capital intensive industry are those that is the direct opposite, requiring little investment in hard assets because the income does not rely on heavy investment in hard assets, but on brand goodwill and patents. So, for example, what I mean by brand goodwill, for example, you have Spritzer, FNCC, Mami Double Decker, all these already have tremendous brand goodwill, even Nestle. So whenever they invest in the factory, the consumption of their product by virtue of their brand goodwill, ensure continuous business process, versus if you are into oil palm plantation, okay, you have a piece of land, you can only plant so much. But to continue developing that industry, you have to acquire more land. So that's why you will continue to spend money. It's just like in the real estate industry, it's the same thing. Okay, you acquire land, you need to build it. Okay, otherwise you can't sell anything. Okay, so in the non-capital intensive industry, for example, patents. What we mean by patents, for example, those in the pharmaceuticals industry, the drug industry. Once you have this particular drug that is being used for medicine, okay, you just continue producing it. You don't need to continuously to invest in factory. Once you have a certain factory, you can maybe invest in equipment that will speed up the production process, or you can maybe extend to existing plot of land to increase the capacity. So the capital investment is very much lower. Okay, capital and non-capital intensive industry, as I mentioned, can exist within the same sector in the main market or in the ACE market. So we look at it, in the trading and services sector. AirAsia is also in the trading and services sector, and Cheetah is a retailer, which is also in the trading and services sector. But can you see the difference? AirAsia, a plane has a fixed capacity. Either they increase the number of journeys, okay, or they invest in new routes, which then require another airplane. An airplane is not cheap, okay? Whereas in Cheetah, okay, if they have already a manufacturing facility, all they need to change is just change the fashion, okay, and then they continue to produce, okay, seasonal and so forth, and whatever stock that they want to clear, they just offer a discount, in the retail outlets, and then another new fashion for that particular season, is introduced. So it's very important for you, okay, to differentiate between the two, okay, because it is to aid you in your financial analysis, as both have differing ratio prerequisites in determining the level of risk to your investment. I will share with you afterwards. Now, capital intensive industry, what are they? So we have here transportation, shipping, highway toll operator. Now, highway toll operator will be is included because you cannot immediately collect toll without the highway being built. And highway, when a highway is being built, it costs hundreds of millions of dollars or even billions of ringgit. Okay, shipping industry is the same. Okay, to move goods, the shipping company need to procure a ship. Okay. And transportation, as we mentioned, like Air Asia, okay, all these are actually capital intensive. Now, construction, property, and REITs, hotels are also capital intensive. Like hotels, okay, you can only rent out the rooms when the hotel is completed, okay, at a cost of several hundred million of ringgit, okay, and then only they can rent it out. Just as in property, in the real estate, you must have completed product to sell to the consumer. Construction, because when let's say that company is constructing a high rise, you need heavy equipment. Okay, you need to have tower cranes. Okay, you need to invest in all this kind of plant and equipment. Okay, to help you build the particular building. Okay, so it is not cheap. Okay, it is not a simple few million here and a few million there. Because if you look at a construction period of, let's say, a construction project, let's say the building of the KLIA2, it took so many years, okay, and so many equipment were actually involved, okay. So the other type of capital intensive are heavy industry, as I mentioned, those in the iron foundry, okay, infrastructure and utilities like power plants. Okay, you need to spend hundreds of millions of ringgit before the power plant is ready for production. Okay, telecommunications because you need to build specific towers. Okay, you need to have satellite, you need to have let's say broadband. All these infrastructure are actually very costly. Okay, then on the other end we have those in the oil and gas industry, the mining industry and plantation. Resource-based industry are mostly heavy, are actually capital intensive. Now, the non-capital intensive industry, some examples are pharmaceuticals and biotech industry, software and technology, because if you have a software that sells, the software could be patented or is proprietary, so continuously it can be used to generate revenue. If you look at it, let's use a US example like Microsoft. Microsoft, they have been selling the Windows, since the 1990s. And today it still continue to generate revenue. Okay, so those proprietary items like technology and software are those that are likely to be patented and possess tremendous brand goodwill. Okay, then you have in the retail sphere, you have trading and finance. Okay, like banks do not need to buy a building before they start a banking business, because they can always rent. So does let's say those in the fast food business, like KFC, they need not really need to buy buildings and all those. Okay, although currently you see a slight departure in a lot of fast food, they are actually building their own, acquiring property and building their own drive-through. But essentially, they still rely on consumption, just like retail, and therefore they are in the non-capital intensive industry. Okay, the others are actually consumer goods, for example, like those from Nestle, BAT, Mami Double Decker, FNCC, okay, and light manufacturing, like bottling plant, okay, and food processing plant. Okay, these are the non-capital intensive industries. Now, this is the I want to share with you earlier the ratios because this is how they are separated. Although in the next session we will talk about fundamental analysis, I will share with you greater detail of how the ratios are being calculated, okay, and how do we set up a KPI-based benchmarking process. A lot of people, when they invest, they don't normally set up their own KPIs, which is very important in a way for you to gauge your risk level, okay. So a lot of people invest sometimes without knowing what kind of risk level are they entering into. And that is why in the fundamental analysis, I will share with you major KPIs that you can use to guide your evaluation of risk. KPI are actually the key performing indicators. Yeah. So let's look at the ratios first because this is how they are being separated. Capital intensive industry current ratio, where the current assets divided by the current liabilities must be, okay, more than 1. Okay. Sorry, capital intensive. Yeah, must be more than 1. So this means that what they have in their current asset, like for example, trade receivables, cash, all these, okay, versus what their liabilities are, for example, short-term borrowings, so-called trade payable, okay, they must be more than 1. Because if let's say it is less than 1, it means that the current, what you have in your current assets would not be able to meet your short-term commitment. So some companies, they have current ratio whereby it's less than 1. So it means that its current asset, including cash that they have and trade receivable, is not enough to pay for trade payable or short-term borrowings and such. So this means that the company will be unable to meet its short-term commitments. And what do this company do? The obvious is to borrow more money. So when your current ratio is very weak, okay, what happens is that they will continue to borrow money. And capital intensive, because already they are borrowing a lot of money, okay, for plant, equipment, investment, land investment, and all those before they can start their business, okay, we set a minimum of 1, okay, at least they must be able to meet its current short-term commitments. Okay, if let's say less than 1, it will borrow again. So when it continues to borrow again, it will increase its debt level, and that puts the company in a very dangerous position. Okay, capital intensive debt to equity ratio. Okay, debt to equity ratio is a measurement of a company leverage. Okay, which means that if the leverage is high, means the company is incurring more liabilities, okay, and when more liabilities there are, it means that the potential risk also increases accordingly, okay. So in this area, we have total liabilities and total equity that must be less than 1.5. So which means, why it must be less than 1? Because no matter what, capital intensive industry will borrow money first before the business even start to generate revenue. So in this case, okay, we allow up to a leverage of 1.5 times its total equity, okay, because anything more than 1.5 would actually increase the risk level of that company. So if you are looking at, which company to invest in, these are the 2 most important ratios that you should look at. Because if let's say the total liabilities over the total equity, okay, is more, runs into 3 or 5, then it's very, very dangerous already, because the company is over leveraging. It has a tremendous high amount of liabilities, which if, let's say, they are unable to pay off in the short term, it means that they will have to continuously borrow money to pay off. So that is very, very important, which is why these are some of the KPIs that I normally set assessment of companies. Okay, you may find that it may be too strict in my okay, but if you go easy on it, for example, you decide to, it's okay, one is too strict, let's adopt 0.5 or 0.6, then you are actually increasing your risk. Now, the whole idea about investment into stocks is to minimize your risk so that you will not overexpose to certain uncertainties. Now, you can imagine if, let's say, the company debt to equity ratio is in the high, let's say 3, 5, or even 6. Can you imagine in a sudden shock like another global financial crisis? Then revenue will be falling down, okay, and suddenly the company have so much debt. How are they going to pay for that? Because when you have a crisis, banks are even more unwilling to lend you without a very, very good credit profile. So when they look at the kind of balance sheet that a company has, the banks will be unwilling to loan them money. So what it does, the company have to sell assets, and in a global financial crisis, if the company have to sell assets, there's no buyers because the economy is very, very poor. And what they do, they have a fire sale. So assuming that they have an asset that costs, let's say, 100 million, they might have to sell it at 50 million. Worse, if let's say they have bought that asset at 120 million and they have to force sell it, at 50 million, then the company would just, have an impairment cost of 70 million for nothing. So that is why it's very important for you to look at these two ratios, because it will determine the kind of risk that you are exposing yourself to. If you want to minimize your risk, then it pays to look at, all this meeting this kind of KPI. Okay. Now, for non-capital intensive industry, current ratio, okay, which is the current asset over current liabilities, must be more than 1.5. Now, you see the difference here. Now, if let's say you are in the non-capital intensive industry, your branding, your goodwill will be enough to help you generate revenue many times over, versus you need to buy a new airplane every time you increase a route. Okay, so that is why the current ratio is increased, because by right they should generate better cash flow. Okay, because you no need to continue to invest in heavy equipment and such. So that is why I adopt, okay, at least a current ratio of more than 1.5. Okay, because it's very movement of goods. It promises a lot of promises good liquidity, okay, to the company. But you'll be surprised when those companies that, let's say, in the light manufacturing, for example, bottling plant or whatsoever, sometimes you have their current ratio, okay, which meets, okay, 1.5. But then this does not end there. It also pays to look at what constitute the current assets. For example, if those are in the trading or in the consumer product, you must look at their cash level as well as trade receivable and trade payable. So I have come across a company couple of years back, okay, where its current ratio looks good, definitely more than 1.5, but its cash level is very, very small versus the trade receivable. Now, if a company trade receivable consists of a very high percentage of its current asset, then it is a concern, because if the economy suffers any shock, the amount of trade receivable might be increased further, because suddenly everyone becomes a very poor creditor. Okay, they are delaying their payment to you. Then you need to extend credit facility to the customers. So always look at it that for current ratio, it's not just the ratio only, but look at both the cash at hand as well as trade receivable. Okay, I have come across a company whereby current ratio is weak, trade receivable is okay, but trade payable is even more than trade receivable. So it really is very important for you to make a right decision that would lower your risk exposure. Okay, so non-capital intensive industry, debt to equity ratio, okay, must be more than 1. So because they are highly, they do not need to borrow so much money, therefore that criteria is become more stringent, okay, to 1. Here, because they need to borrow money to start off the business, I allow a KPI of up to 1.5. But if let's say they do not need to borrow a lot of money, and the business, they can continue the process, okay, and generate income. Therefore, I do not foresee that they need to continue borrowing a lot of money, and therefore, the debt to equity ratio must be less than 1. Okay, so this is how I actually differentiate the industry, okay, to capital and non-capital, in order for me to know how to ascertain my risk exposure, and these are the KPIs that I use. Okay, so it's very important because the above are to separate the weak companies from the strong. Okay, bear that in mind. So I think there'll be quite a lot of questions and answers session. So any questions, please, you can ask now.
Hello. Hi, PC.
Yeah.
Can you hear me?
Yeah.
Right. So there are a couple of questions, but while waiting for their questions, why don't we just have something fun? All right. I'm going to launch a poll now. So where do you think KLCI will go tomorrow? So there's a poll. Okay, I'm going to launch a poll when
Supposed to be on Thursday morning after the you're referring to the Fed, is it?
no. I'm asking them. So where do you
Okay.
think KLCI index will go tomorrow? Is it up more than 15 point, down more than 15 point, remain plus minus 15 points range? All right. You can tick now while waiting for the rest to write in the questions. All right. PC, today you ended a little bit earlier.
Yeah, because I'm expecting a lot of questions on the indexes,
Yeah.
okay, as well as the capital and non-capital stuff.
While we're waiting for them to vote, can I ask this question? Just now you mentioned the sponsor. So what does a sponsor do?
The sponsor is like a company that actually, if I'm not wrong, okay, that will actually put in the money, okay, a reputable company will put in its money into that startup, okay. So it becomes a startup before it can apply for a listing. So that particular company that invests into that startup, okay, in the ACE market, that would be the main sponsor.
So it's like an investor,
Yes, yeah.
but he has to remain invested for the past 3 years before for the next
Yes,
3 years
yes,
before.
yes. Even
Okay.
after they have, yeah, for example, like certain venture capitalist companies and such, yeah. So they will be the sponsor.
Oh, okay. Right. I thought you will cover more on the some of the index like multi-dry index or you know. But we have
that one,
okay, we have 67% people voted. There are still 37% people not yet voted, but it's alright. It's just for fun only. So yeah, I would just should I close the poll now? We have 73% voted. All right, so let's close the poll now, okay? Okay, wait, I want to show you the result. Okay, this is the result. So we have 4% of you believe tomorrow it will bull market. 33% of you would think that tomorrow will be a bear market, but majority of you will think that it will be ranging in between 15 points now. So all right, so that's a little bit about it. Okay, so let's continue to our slide. Okay, so question and answer. I have a few questions here. Wait, let me see. So first question is before I open it up to them, PC, you know that tomorrow it will be the tomorrow night, which is the US Wednesday afternoon.
Mm-hmm. Mm-hmm.
The FOMC Federal Open Monetary Market Committee will convene and discuss about whether they want to raise the interest rate for federal fund rate. It will, no, after the interest rate remained all-time low for the past 8 years since the last subprime crisis, I think the Federal Reserve is expected to raise rate tomorrow. So in the event that the Federal Reserve, Janet Yellen really raise the rate, what do you think would happen to the stock market worldwide? And also, what do you think about it will happen to the Malaysian market?
I think more or less everyone has accepted that the Federal Reserve would raise at least 25 basis points. But that 25 basis point would have a lot of impact globally. Let's talk about globally first. During the last few years, a lot of companies, including Malaysian companies, okay, and even Malaysian government, and those companies in Asia Pacific have actually borrowed based on the low interest rate for the US dollar. Okay, they actually have borrowed a lot, but any increase in the interest rate will actually increase the burden of payment because increase in interest rate will cause the dollar to be stronger, and therefore for those that borrow, let's say just as early as 2014, Malaysian companies that borrow in 2014 where the ringgit to the US dollar is 3.2. With just the anticipation of the hike in interest rate, okay, coupled with the fall in commodity prices, right now, those companies that borrow in terms of US dollars have to pay at 4.3. So already the debt burden has increased almost 30+%. So that is why if further rates occur, then we will likely see more default globally, especially in China. You will see that already 6 very big state-owned companies are unable to pay interest due to the bonds. And right now, they are identifying another 5. So the sequence of default in China could be very, very high. And what we are seeing now also in the US, a lot of the US oil producers called the shale producers, they actually borrow cheap debt to continue drilling for oil. So with oil dropping, they actually incur a lot of loss in revenue. But what is also causing them further problem is that a lot of the drilling are being financed by debt. When US increase interest rate, it means that if they want to borrow new money, they have to pay more. So that's why 2016 will see a tremendous default and possibly bankruptcy among the shale oil producers. So when this is taken out, hopefully it will start a new trending of oil price moving upwards. Because right now the shale oil drillers are actually producing about close to 9 million barrels of oil per day. Okay, now it has dropped to below 8.9 or 8.8 million barrels of oil per day. Okay, so but because oil price is going down, it will create a double whammy for them. Okay, coupled with increased interest rate. So in Malaysia, what we will likely see is that if, let's say, the US dollar strengthen, companies in Malaysia that earns their revenue in US dollar would be the major benefactor, okay? Which means they will actually have higher revenue, okay, to actually continue to deliver perhaps good profit results. And I don't think the Federal Reserve would continue to increase interest rate in 2016 because this is the increase and see how the market accepts it before they will either increase it again or not. But I think because the whole global economy is pretty weak, this will be a one-time off increase. But then there's some who say that the Federal Reserve may decide not to increase at all tomorrow, okay, because in the last 2 days there has been a sell-off in a lot of high-yield bonds. So the sell-off in high-yield bonds is actually mirroring what happened in 2007 and 2008, that the high-yield bonds were the first to suffer a sell-off before the economy collapsed. So that's why it's like reminding a second replay of, it's like reminding a second play of what happened in 2007 and 2008. So, but however I see it, the Fed will definitely increase interest rate because they have been saying it for the whole year, and December is the last time they can say it anymore. If they do not raise interest rate, then the Federal Reserve credibility will be lost.
Yeah, like Janet Yellen have been saying that in 2015 they'll definitely do it once, but tomorrow is the last meeting already. I guess they're going to do it.
Yeah. If they don't do it, they will have lost credibility. But their credibility already lost anyway, because after they do it, the chances for a global recession, Citibank actually put it at. So we don't know how it will play out, okay? But I think there'll be some defensive positions that you can take in the Malaysian stock market. As I mentioned, oil services companies in Malaysia are badly affected by the oil price. So I would look for news that the US shale oil production will reduce dramatically and a lot of bankruptcy which will happen, then it will boost the price of oil. If let's say the price of oil goes up, most likely certain oil services company in Malaysia would also be the benefactor. Okay, so these are the things to look forward to.
Oh, I see. So if the raising US interest rate would cause so much of turmoil in the US companies, why would the Fed want to do that?
I think first and foremost that, like I say, it becomes a credibility problem. They've been saying, since early of this year, and if it don't happen, then people say the Federal Reserve cannot be trusted. And if let's say they don't, they will say that the economy is actually worsening. That's why the Federal Reserve is not going to increase interest rate. So by increasing interest rate, it will first of all reassure people that the US economy is well. And secondly, by increasing interest rate, it will also help boost the strength of the US dollar. So when it boosts the strength of the US dollar, it will signal to the market US economy is healthy. But if you look at the trend, it's actually not. Okay, US economy is definitely not doing too well. Okay, their debt to GDP level has gone. As a country, it is now almost 300% of GDP, including corporate debt and private debt and government debt. Okay, but as government debt itself is already 100% of GDP. So no matter how you see it, increasing in interest rate will just add on to the burden of payment on the US government. So what they do, they will continue to borrow more. So as you borrow more, you pay interest more, then you tend to borrow some more. You see, so that is why when I talk about just now, when we look at leverage in the debt to equity ratio, because once you have a debt that keeps on rolling over and over, it will never stop, and the debt will actually increase. So that's why what will likely happen is that I think with this one increase, by next year could be a QE4 with negative interest rate. So because after the experiment, they say, oh, actually the US is not so well, so now we will do another QE. So that could happen, and chances are it can happen. Okay, so if let's say they do another QE, then the global stock market, would have another burst of energy. But this burst of energy also cannot last long, because most likely, companies will continue to accumulate more debt, because suddenly they find it, oh, now I can pay for my debt even cheaper, so they borrow some more. So the debt crisis is a worldwide crisis, and it's just not restricted to US. But if you look at it, Japan debt to equity, Japan's debt to GDP is, some people put it around 500%. China is already 300%, and US is also 300%. If you look at it, the 2007-2008 financial crisis, total debt to GDP in the US was 61%, government debt, but right now it's 100 over percent. So it's even worse. Global debt since 2007 to 2015, 2014, global debt from that period to now has increased 200%. So if let's say a crisis happens, a debt-driven crisis, it will be worse than 2008. Okay, but these are all what people say. We still have yet to see how it is played out.
Okay.
Most importantly, this period is to look at investment that are safe to a certain extent, in that you know how you put your money into strong companies that would likely survive.
Okay,
Okay.
understand. Thank you very much, PC. So let's go to the next questions. Now, as we know, the inventory is assumed to be current asset. Then, assuming the financial crisis happens, inventory is not liquidable. So can I ask, what is the best ratio? Is it a quick ratio?
I think most importantly, okay, yes, inventory is although part of the current asset, but in an economy that is not doing well, it can be a burden. So I would recommend that if let's say a company, always look at the company cash, okay, cash flow for that matter. If let's say the company have uh, cash versus the inventory, okay, that's more cash, then likelihood that company would be able to pull through. If let's say it's just very low cash, no matter how I see cash as very important, okay. You need to look at the inventory. Sometimes retailers, they might have let's say stock holding days, yeah. And if let's say a retailer, a stock holding days exceeding, let's say maybe 90 days, could be quite troublesome, because if you look at it, standard industry is actually less than 90 days. So these are the things that you have to look out in reading the quarterly report. I still emphasize a lot when it comes to the current ratio. Look at the cash. It must be, if let's say there's more cash generated this year than next year, than previous year, then it is a good indication. Okay. But if let's say the cash has suddenly fallen compared to last year, then it should raise some concern. These are the things to look out for.
Okay, I see. Thank you, PC. So we have next question from Sun Rongsheng. Is it the A's market are mainly for new company or the growth stock?
Actually, you can say for both, because growth stocks sometimes with potential for great progress. They will use the ACE market as an opportunity for them to roll out their plans. Okay, it doesn't mean that it has to be restricted to new market or not, but whenever they list in the ACE market, every company is actually new to a certain extent, as long as they meet the kind of guidelines. Okay, but if you want to look at growth companies, you must understand what is their potential, number one. Is their business, able to be a pioneer? Okay, which means they are breaking new grounds. They are the only one right now in the region or in the country. Okay, if let's say the nature of their business is, can be copied elsewhere, then that growth will not last long. Just to share with you, for example, if that company, is in those, coupon kind of things, okay, everyone can just issue a coupon and then, generate the business. So that business can be so easily replicated. It doesn't bring growth to the company. So always look at what is the company core business, okay? And you should be guided by that. Whether it's copyable, the business easily replicable, and whether it is, a pioneer in the industry, then that would actually show you the way whether, it is worthwhile taking the risk.
Okay, I see. So thank you very much. The next question is, I would like to know sometimes when we are choosing between which stock to invest, we will look at the PE ratio. But the PE ratio shown in our trading account or even some other screener will actually keep on changing every day. May I know which one should I refer to and how to differentiate? Is it an accurate PE ratio?
Okay, the PE ratio keeps on changing because PE ratio means price to earning ratio. So as long as the share price keep on changing, that ratio can change. Yeah. So if let's say the daily fluctuation is very high, okay, like in what happened in the Shanghai stock market crash, you have a lot of IT companies that have earnings of let's say 1 million, okay, then their PE ratio, do you know how high they could go? Is actually 100 over. Now 100 over, how can the company be valued 100 over times its PE? And you'll be surprised here. If you have the time, I'm not going to tell you, but let you discover on yourself. You go and look up Amazon. Okay, Amazon company listed on the Nasdaq, and you look at its PE. Okay, it is very, very dangerous. Okay, but I won't tell you what it is. You go and have a look. Okay, now when the price of the share price goes up, the PE ratio would go up. Or when the company announces its earnings, okay, its average earning for that year may drop, but the share price may never change. But then the PE can still go up. So that's why it's very important. Okay, don't just look investment. Don't just look at the PE. First of all, the first test of a company, okay, is not its share price. Okay, if you just look at its share price versus earnings, or everyone says that PE low can buy, you most likely will suffer losses. When I first started out in the 1990s, okay, learning the ropes of investment, I also follow everyone say buy when PE is low, So I buy, eventually, I lost all my investment after I make money from my investment. So in the end, you get nothing. Okay, that's what happened when I just listen to people for PE. Now, the most important thing of a company, I always stress, is the balance sheet, okay, and income statement. Because if the company has a very strong balance sheet, you need not fear, okay, what are the economic shocks that are coming. So that is why look at the balance sheet, then look at the income statement. If you have a strong balance sheet, but the income, that is generated is below average, then it's not worthwhile an investment also, because it's just a matter of time before the assets, okay, in the balance sheet will be consumed, okay, to just cover the business, the operations of the business. So look at the income statement, look at the balance sheet, and in the next lesson, I will share with you how this is done, okay, and what you should look out for. But don't base it just on the PE, okay. Any company can exhibit a PE ratio that, that is low and therefore is investable, but its balance sheet may not be strong. And before you know it, Okay, it could be a PN4 or delisted or something like that. So don't look at the PE. PE is not a good guidance, okay, because the share price keep on fluctuating and it will affect the ratio anyway. Look at its balance sheet and income statement.
Okay, thank you, PC. So now the next question is probably somebody who logged in a little bit late because we have covered, but for since you had asked it, maybe you want to explain briefly. He's asked, why are there two markets? What are the main differences?
I think the two markets are actually to differentiate one, the mature market, which is the main market, and the ACE market is to allow company that want to acquire public funding for their business. They can do likewise in the secondary ACE market. Because if let's say all the companies, there's no ACE market, but companies have tremendous growth potential and so on, they cannot draw on public funding to expand their business concept or ideas or revolution to any industry, So that's why there's a secondary market, so that startups and all those has a means to acquire public fund, okay, for them to expand, grow the business, or maybe one day they have mature enough to move into the main market. So that's the difference. You will see that it happens to a lot of indexes. For example, although in US you have the Dow 30, but it's only 30 market, S&P 30 components, 30 companies. So in the S&P 500 companies, do you know that they have a Russell 2000, which actually monitors the movement of 2,000 plus companies? Then the Nasdaq itself is also for startup, biotech startup, IT startup, those technology stocks, but they must have a minimum value of $1. Okay, so a lot of markets around the world, they actually have a secondary market to allow entrance of new companies, okay, or dynamic companies with revolution technology and all this to draw public funds for their expansion, and that's why there's these two markets.
Okay, thank you. So the next question is, any fundamental aspect should we focus more before we select a counter?
I think the most important, the fundamental aspect actually have a series of KPI, and I think next lesson, okay, I will share with you a list of KPIs, but I will share with you how I do it normally. I will have a list of KPIs, and company I select must meet this kind of KPIs, but that's not the end. I would also gauge what are its competitor or peers in the industry. Then I list down their KPI. The company that meets the most KPI, then I will select as the likely candidate for investment. Okay, so it's a matter of if you know the fundamental analysis, you look at company A, B, C, then you tick off. Okay, this KPI met, yes, 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 no, yes, no. The company with the most yes would then be my candidate. But even to that extent, that KPI as a candidate must also meet the key issues like current ratio, at least current ratio, okay, and the profit and revenue growth, okay. So if let's say the company doesn't meet, they have revenue growth but no profit growth, what are the reasons? So you must be, most importantly, when you want to invest, always be a financial detective, okay. Do not follow so much as what people tell you, okay. And although you can read from the newspaper, well-known analysts say do this, do that, but always measure it against your own analysis, because some analysts may say certain things based on that period of time, but it may not happen. Okay, if let's say analysts are, if everyone who follow all the analysts are really accurate, I think a lot of people will be multi-millionaires by now. So that is why it's still back to your own homework, because once you know it, then you are able to tell yourself, I know that this is the risk level that I'm facing, so I'm prepared to face the risk. That is different from that person told me to invest and I just invest only. Because one comes with a commitment, the other is just hearsay. So that's why it's very important for you to do that kind of analysis so that you become efficient in it. Now, when I was first doing those kind of comparison and analysis, it took me quite a long time. Nowadays, I can, let's say, if I really want to, I can analyze, 10 to 20 companies a day, if I really want to, because it is so fast looking at the balance sheet and so on, But practice makes perfect, so that you become good in it. And when people say buy, you will check first. Well, maybe their risk is higher. They want to take a higher risk. That's why they recommend. But I want to lower my risk. I want to be a bit safe, and therefore I do not want to buy. But I will look at this company instead. So always do that. Then you become better at what you do.
Okay. So the next question by Mr. Cool is that I read the question. Last time, got one investor told me that if we wanted to judge a stock price, we actually can use a formula which is EPS times P is equal to P. That means earning per share times P ratio is equal to the price. Is this formula accurate? Because P ratio keeps on changing every day based on the market price. Yeah, that's the question.
I think just now, as I mentioned, if let's say your analysis is based on fundamentals, it has strong balance sheet, it has good earning potential, it doesn't matter what the price, to the earning ratio is, as long as you know that it is good value, based on its measurement versus the peer. And that's why in the fundamental analysis, I will share with you one of the KPIs which I use, is actually the share price versus the net value at the net asset value per share, to let you know whether it is below book value, or is it above book value, but by how many times. So that is how you know whether that stock is it undervalued or overvalued versus the peer. So when you just look at PE, it doesn't tell you much information actually. Does it tell you that, assuming if the PE is very, very low, then does it mean that the share price that the share price have not been factored in? People don't find this stock attractive, or is it this stock is undervalued? You won't know until, let's say, you go back to the fundamental, look at its share price to net asset value per share, and then you will know. So these are the important things that just based on PE you won't know much. It will tell you a very rough picture, but it won't tell you whether a company is strong financially. Because if you know a company is financially strong, and you know that it has potential, and you know that it's undervalued based on some of the analysis that in the next lesson I'll share with you, then you will likely be able to lower your risk. Now, no investment is 100% that you will make money, but before you even think about making money, is how to mitigate your risk, is how to lower your risk exposure, because only then you will have proper allocation of your cash resources. If you do not do those kind of homework, then you are likely to put your money with the hope, that it will go up because people tell you that. Actually, fundamental analysis carries with it a lot of weightage in determining that you should buy or not buy a certain share.
Okay, thank you. The next question is about interest rate. The question is very simple. Could you explain what is basis point?
Okay. Normally, the basis point is like quarter basis point means it's 0.25%. 100 basis point is actually 1%. So that is how banks talk among themselves in that language. It doesn't mean 25%. Yeah? When they say 25 basis point, means that it is 0.25%. So normally banks work their interest rate based on 25 basis points, because 25 times 4, becomes 100 basis point. It's much easier to do. But there are banks that can just reduce 10 basis point, like the European Central Bank recently reduced the interest rate by minus 10 basis points. So now it becomes minus 30 basis point. In Europe, actually, if you keep your money, the bank will charge you more. So if you keep, let's say 1,000, the bank will charge you, 30 euros. Okay, if you have 1,000 euros there. So because they want people to take out the money and invest, spend, and all those to grow the economy. That's why if you keep your money, there is a penalty. And that's what the ECB is doing.
Okay. So next question. From what I know, indices generally display the market performance of a region or a country as a whole. So how true is it that an index will always recover from a major fall?
I think always know that how all the market react after a major shock. Okay, is that if, let's say, a shock is continued, what governments will face then is that there could be an uprising, social unrest, okay, and a lot of negative things that can happen to a country. Okay, that is why governments around the world would, as soon as they detect, as soon as a crisis appears, you will see all of them firing on all cylinders to pull the country out of a catastrophe. Okay, because if not, then you will see a lot of social unrest, okay, and the well-being of the country and the wealth of the country, okay, would actually be damaged. So that is why no matter whenever there's a down cycle, there will always be an up cycle eventually, and this has been demonstrated ever since the stock markets have been in the history since 100 over years ago. There's always up and down cycles. Now, if you are buying on the up cycle, okay, that is why people say don't always hope perpetually that the market will go up, okay. But if you are going on an up cycle, then always look back on what are the defensive play, okay, so that for those that are more speculative, you get out and route to the top cycle, okay, leaving those that with high dividend so that you continue to enjoy good dividend pay. Okay, some like in the current environment, okay, that potentially because the whole global economy looks pretty weak right now. Then I will look at, if any investment, I will look at companies that have that is backed by lots of cash and hard assets. Okay, I mean assets like real properties and all those. That's why I often favor REITs to a certain extent, because if you are looking for REITs that deliver, let's say 7% dividend, okay, any shortfall, okay, in a crisis, okay, would see the payment dropping maybe 30%, okay, or 40%. Now, that means that if, let's say it's 40%, 7% less 40%, okay, you still get about 4.2% dividend payment, which will still be better than, putting your money in an FD. And also, during a down cycle, it's the best time to collect risk, because when they finally start to improve, okay, you will actually get a higher yield because you buy at the lower end. So these are the kind of plays that you can look at as defensive play in preparation for some down cycle, or you can actually exit and wait for opportunities to buy on the lower end. But it's very difficult to predict the bottom in the down cycle. Like from 2007, late 2007 until 2008, that's it's so difficult to predict a bottom. Only in 2009, you see it started to lift back up. So I often tell people, if let's say you feel that you want to be on the safe side, it's best you liquidate, okay, leaving some good dividend paying stocks, okay, and wait for the opportunity, so that you won't buy at the bottom, but when it starts to lift off from the bottom, you will know that the trend will likely to continue. So that is when you can actually put in your money. At least you buy closer to the bottom, but you still enjoy tremendous growth in terms of profit or dividend yield later on. So definitely any cycle that will always go up. It all depends on the length of the cycle. So that is why, don't continuously buy, average down. A lot of people like to stress average down, I'm not the type that will recommend average down, because if let's say there's a shock to the global economy, okay, you do not know where's the bottom. So if you buy when it's 50%, well, if you drop another 20, 30%, you won't know. So that is why don't always look at average down when let's say there's a crisis, because you do not know where's the bottom. Only when the bottom starts to move up, then you know that, okay, now it's time to average down. Then by the time you average down, you could be about 70% discounted. You don't know, you see. But if you keep on 20, 30, you keep on averaging down, then how much money you spend on a particular share. So always remember, average down, use it to your best best benefit. Okay, don't average down because the share price has just gone down. Okay.
Okay, thank you, PC. Now we have good questions coming in again. Now, if US raise the interest rate, the US bond will become very attractive. So now we saw that the circumstances that the US has a lot of debt, and nobody want to buy their debt. Okay, so all right, this is not a question, this is a statement, is it?
I think I would agree to that because if the US debt is already 100, government debt we are talking, government debt only is already more than 100% of GDP, and just in November itself, the debt was actually in October was around 18.2 trillion US dollars, but in November, at the end of November, it went up to 18.8 trillion. So you can see that right now, the US debt will keep on escalating all the way until the president election, because next year is US president election. No one wants to be the bad guy who will say close the, have a crisis and close the government offices like what they did last time. Okay, so they say that the debt limit is suspended until 2017 January. So you will know that in 2016, the US just power on the debt, it's free for all. It's because there's no Congress, there's no Senate that will actually, vote to push for that limit, because it's just continue to pay off the debts and all those things. So yes, US bond will increase in price, but then what about the debt that is continue to, roll up and up and up? So there are talks that eventually some of the proponents are saying that one of the best thing to fight against the debt is to invest in companies that have gold. Okay, so these are what some of the proponents are saying. Because that's why you have to look at it. If let's say the economy tanks, normally there will be some other kind of investment. So some are saying that there could be a return to commodity. Okay, and we can only wait and see, because we do not know when it will crash. Okay, so we may see a return that palm oil price may be better. Why? Because if US do crash, the US dollar will actually fall in value. Now, when it fall in value, it means that commodity prices will be higher. Okay, so it will benefit. For example, if company in Malaysia that is a gold retailer, maybe gold price can actually increase. Okay, and those in the palm oil could actually finally see that the palm oil price improving. Okay, these are the trends to look out for, because if the US do crash, you can rest assured, there'll be a lot of QE or whatever that comes out to support the economy. So all this would actually boost the price of commodity. Okay, so that's why I say pay attention to what is going to happen outside of Malaysia, because it can influence your investment in Malaysia. Because if US dollar fall together with the crash, rest assured commodity price would actually improve. Okay.
Okay, so it's about 10 o'clock now, but we still have a couple of questions not yet answered. And if you have any question, please don't post it now because we already run out of time. All right, so this is a so we'll just finish up all the questions that we received so far. All right, what the questions now is so PC appreciate you can answer it in brief. Thanks for answering the PE ratio question just now. When you look at the balance sheet and financial statement, it is considered as fundamental analysis, right? So if fundamental analysis shows us that the company is good, but we look at the technical analysis, it might show us that it is not the right time to buy. So how do we really combine both fundamental and technical analysis so that we can know which stock to buy? When is it the right time? Or should I just focus in fundamental analysis? Because some chart might show us that the price of a stock is almost reached the resistance points. End of question.
Okay, like I say, in the next lesson, I will share with you, one of the measurements I use is actually the share price versus the net asset value per share. And that will show you whether for example, if the share price versus the net value per share is more than 3 times, you have to ask yourself, would you pay for a company that is already 3 times the book value? So that would readily answer your question. Otherwise, yes, technical analysis will tell you, that it is near resistance point and you should not buy. You can also check whether what is the share price to the net asset value per share. Is it acceptable or not acceptable? Okay.
Okay, so the next question also by the same person who asked the question is, what I measure a stock is according to ROE, return on equity. Is it correct? So the question is,
I think return on equity is one of the measurement, but I don't always look at all types of ratio, but you can use it. There's nothing wrong in it. For example, for me, if I look at profit growth, okay, then I know that this company is generating positive earnings, and to that extent, the return on equity to me then becomes a secondary subject already. What is important that I know that its balance sheet is very strong, okay, there is growth in its asset versus last year, okay, then that would actually tell me that this company is in the right direction. But to be more detailed, yes, you can use return on equity to see whether it is, these are all other things that will help you improve your analysis. If you do one more type of analysis, it doesn't mean that it's wrong. In fact, you are doing something that even better. Okay, so have it in as a combination then.
okay, great. Now the second last questions. Comparing TA and FA, which is more effective to choose a counter?
I think for me, I will always look at fundamental analysis. Okay, because a company must have underlying fundamental strength financially. Because whatever investment I make, I want to ensure at least the company is able to survive external shocks. So that's why I always fall back on fundamental analysis.
Yeah, if I may add on, usually people use fundamental analysis to choose a counter and use technical analysis to time the entry, usually. But some people have
Yes,
different
yes.
strategy. Now, last question already. Finally, come to the last question of the webinar. Can I ask why the US dollar is so strong even though they have a lot of debt?
I think most importantly is that the US dollar is a global trade currency because 60% to 70% of global trade is using the US dollar, and therefore that's why it's very, very strong. Okay, because there's demand for it. Okay, like I say previously, there must be demand. Okay, in order for it to have better pricing. So that's why that's the reason. But you'll see that right now there's a slight departure, and that's why US dollar could fall in the future because what drives the US dollar is actually the petrol dollar. Petrol dollar is you see the WTI, is actually traded in US dollar, and even the Brent. So what happened is that right now you have Russia and China, okay, having trade that is interchangeable between the ruble and the Chinese renminbi, okay, in the trading of oil, and also Saudi Arabia and a number of Middle East countries may depart from the petrol dollar to trade directly with China using a different currency platform. So if let's say they move it to the move away from the petrodollar, the US dollar might fall. But currently, because expectation of interest rate and things like that, the US dollar is strong. But with its debt keep on accumulating, it's just a matter of time before people would lose confidence, because the US currency is just a currency that is not backed by anything. It's not backed by gold, it's not backed by silver, it's just a currency that the government, that the Federal Reserve issue out. Okay.
Yeah, I think most of the currency around the world are fiat currency. They're not backed by anything.
Yes,
they're backed by
but
that.
There are chances are that it might be backed by gold eventually. If you have the time, you go to the you go and look at some of the YouTube where the IMF has actually stated there is likelihood to be a currency reset. Okay, and that could change a lot of the global economy, the dynamics of the global economy.
Okay. Well, thank you very much, PC, for your sharing.
Thank you for listening.
We have spent 45 minutes for the talk and another 45 minutes for Q&A. The Q&A session is so long. All right. It just shows that our audience are really inquisitive and ask good questions. Are not sleeping. At least they are not sleeping. Okay. Because when we are doing a webinar, we don't know whether they are listening to the screen or not. But yeah, we have a good turnout, and then I think our discussion was really quite interesting. Some people are really asking about US dollar and how can it affect the Malaysian market.
Yeah.
So
you can write to me at this email address if you want to have if you have some other question. I'll try my best to answer.
Okay, so if you have any question, write to wpuichi@gmail.com. All right. So yeah, time you come and answer this. All right. So thank you very much for attending our Bursa Investor Club webinar series number 3, understanding the market sector and indices. So we hope you have a good experience, and hope we have served as a good guidelines for you on how you can improve your investment decisions and trading decisions as well. So thank you very much for coming, and may you all have a pleasant evening. Thank you.
Yeah. Thank you.
Okay, bye
Good
bye.
night.